There are people who think that, hey, the US dollar is a fiat currency. It's not really backed by anything except for the good faith of the government. And will our government be around forever in perpetuity? Or will something happen? Will the dollar collapse? Will China become the new superpower?
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, my great to wealth listeners. Today, I have the pleasure to speak to my good friend, Matt Picheny. Our paths have crossed a lot of times in the similar circles, the similar kind of stuff, but he's way more talented than I am. I actually just learned a few minutes ago that he was an actor on Broadway, on theater. So this is amazing. We'll jump into that story as a little bit as well. Matt, welcome to the show, buddy.
Hey, thanks for having me on. It's a pleasure to be here.
Of course, man, of course. So, Matt, tell one thing that we always open the show with. We don't necessarily do a formal introduction because I think your story will speak for itself. What does the term migrate to wealth mean to you when you hear that term, migrate to wealth?
Well, I think it's about moving from, when I think of wealth, it's not necessarily like rich. It's not, obviously money, but I think there's more to wealth than just money, right? I think holistically health and just like a state of well-being and comfortability versus kind of like being more, running after and trying to sort of like get that paycheck and, almost like, not that a lot of people, there are a lot of people living paycheck to paycheck, but maybe not necessarily your audience, moving into a place where you're not so concerned about money, about finances, where you've got a good understanding of it, you're holding on to it. So sort of moving from that kind of like trying to achieve to the comfortability and stability. That's what I think.
So Matt, how are you doing on that journey for yourself? Where are you?
Well, I think we're doing well on that. I'm not in a place where, being the way that I was raised, I'll never be in a place where money is no object to me, and I'm just throwing cash into a fire pit or something like that.
Yeah.
I come from a somewhat humble beginnings. To give you an example, in high school, I went to a high school where there were some kids whose parents bought them, like a brand new car, BMW or something like that. Like there were some kids like that. There were other kids who, had to ride the bus, right? Once I turned 16, my parents did help me pay for a down payment on a Volkswagen Fox. If anyone knows what that
I remember that car, man. Yeah.
Yeah. I had a Volkswagen Fox. My folks did help me with the down payment. I paid the majority of it. And then I had to work a job and make the car payments. And so, I didn't, my parents didn't like buy me a car or anything, but I don't want to say like I didn't grow up in abject poverty either, but I wasn't, I don't come from wealth, I would say, except I did have a wonderful family. And so from that perspective, I was very wealthy when it comes to that. But when it comes to dollars and cents, I didn't really come from that. At this point, I live in a nice place. I drive a car. I drive a Subaru Forester. I'm not driving around in a Lamborghini.
Not yet.
I've got a wife and 2 children. My wife loves her job. So even if she could leave her job, she never will because she loves it so much. But we're also not in a position where, I'm checking the bank account every day. I have some good passive investments, just real quick for your listeners. I work in multifamily and I have over 10,000 apartment units that I've invested in nationwide. And 2/3 of that portfolio are investments that I've made as a limited partner, right? As a passive investor with people who I've gotten to know and like and trust. And hopefully they are able to operate the deals profitably. But then I have, 1/3 of that portfolio, a little over 4,500 units that I'm a general partner on, that I am managing those assets and I am day-to-day involved in the operations.
So Matt, interestingly, you used the word hopeful in one of as you described the other syndicators that you invested along with. Let's jump on that for a second. And maybe you didn't mean to use that word, but because you used it, I'm going to ask, why did you use that term, hopeful?
Well, I think that we as passive investors, right, can do as much due diligence as we want but we won't really know what's going to happen until the thing has happened, right?
Right.
And when we're looking at the market, like today's market is very tough. So I may have invested in a deal with a very good operator, and it may have been a very good, market, meaning the location of the property, and the business plan may have been very good, but they may be experiencing some stress right now.
Right.
So, there are things that can be controlled. There are things that can be, that you can foresee. But there are conditions that are beyond our control and that are unforeseeable. So there is a degree of risk in any sort of investment. And so I'm always hopeful that the risk doesn't turn out to be, a worst case scenario, I guess.
Yeah, and I think that's a beautiful thing, right? Because I think that's really what I was hoping to get. That hope is not an investment strategy, because you have to do your due diligence before you even put a cent into a deal, into an opportunity, especially that you're not intimately being familiar with, because you're not running day to day. But I think what happens is, even though the operator may be perfect in terms of their operations, their track record, and their understanding, their business savviness, market may shift. All right, so the hope is always going to be there. There's always a risk. Just because you're investing with somebody who is a good operator, quote unquote, and that could be a lot of different things that we can go deeper on that one as well. It does not mean a deal's going to always work in your favor, especially the way it was planned. It may look entirely different or slightly different in the next 3 to 5 years before the exit. So you have to be cognizant of that as well, especially with the transition right now. Let's talk about that, Matt. Shifting. Actually, before we even do that, let's talk about your other talent. How did you crack into being in theater? Tell us more of that, and then we'll talk about the journey of you being an actor to you being directing a real estate deal.
Sure. Well, so I was always interested in the arts and performing. I think my first performance was playing the role of a little bird in kindergarten, where I ran across stage. My mom tells me flapping my arms, but I
can imagine.
I don't really remember that. I do remember my 5th grade play and doing that, and really just really liking it and being something that I was passionate about. And I, from probably about 5th grade on, always wanted to pursue a career in theater. So as a kid growing up, I was very involved in community theater and different programs and things of that nature. And I moved to New York City in 1992 to go to a musical theater conservatory. It's called the American Musical and Dramatic Academy. And so I graduated from there a couple of years later. And 3 days after graduation was actually off on the road doing a national tour of Aladdin, the show Aladdin.
Oh, wow.
I had a fun time and an interesting career in the theater. I was a professional actor for about 5 years or so. What happened for me was the internet was becoming a thing, talking like 96, 97. And I started not wanting to be doing a lot of like regional theater or tours or things of that nature. Was waiting for a Broadway show. I had several callbacks for Broadway shows, and ended up actually starting my own boutique web development agency back in the .com heydays until 2001, when the .com bubble burst.
Yeah.
And that's when I got a call from my landlord telling me that I had 90 days to get out of the apartment I was living in. So I went in-house at Showtime, the cable television channel. They were a client of mine. So I went in-house there and was looking for a place to rent, but I actually found a place that I could buy. I bought it. And a couple of years later, I sold it and more than quadrupled my initial investment in the property. And then I was like, okay,
why am I not doing this?
Yeah. I was making good money at that time. This was 2002, 2003. And I was making 6 figures, which for me at that time, like that was good money.
Yeah.
But that one real estate transaction was more than a whole year's worth of salary. And I was like, okay, we need to figure this thing out. And so, but at that point, I had really decided that I was having so much fun doing what I was doing, and I really hadn't been acting for a long time, and that I just kind of wasn't an actor anymore. It was never like a conscious decision of like, I'm not going to do this anymore, but it just kind of evolved. And now that I am doing real estate full time, I have also been able to work with my wife, who actually works on the business side of Broadway. And we've actually co-produced a couple of musicals together. So we got a couple of Tony Awards for that, which is fun. So I'm still having thank you. So I still have, like a finger in that. I'm still a big supporter of the arts. I think they're very important. And I'm glad that I can stay connected to that. But my day work is all in real estate.
In real estate, a soft spot for theater. I like that. And thank you for sharing that story. So Matt, let's move forward, man. As you reflect back on your journey of the first place you bought in 2002-ish time frame.
Yes, I bought it in 2001. It was the very end of 2001.
Perfect. And then to now owning or invested in over 10 units, right? As you reflect on that journey and as you look forward, let's paint a picture for the audience here. How do you see the market changing? I mean, everyone knows about the interest rates. Everyone knows. But I don't think everyone understands the impact of interest rates, especially as an investor, especially as a real estate investor. So could we dump it down and kind of help us paint the picture of what this was before and what could they have to look like?
Yeah. So I have a book that I wrote called Backstage Guide to Real Estate. And inside the book, I share about my journey and I share 18 keystone concepts that I've learned along the way. And one of the earlier concepts, I think it was keystone concept number 5, is cash flow is king. This is something that I learned early on. That first place that I bought that I had mentioned, I did very well, right? I was in a market that was definitely on its way up. And I bought in a location that was on its way up, and we made improvements to the property. I mean, it was technically, for those of your listeners who know what a value add is, right? It was a value add. I didn't know it was a value add. I knew that I could buy this place and I could pay the mortgage and that it made sense and that the unit itself needed a little bit of work, but the building itself was in just, I want to say terrible shape. It just looked really, really, really dated. And as a member of it was a co-op. So as a member of the co-op, I was actually asked to be on a committee, and we redid the lobbies and the hallways and the elevators. And so 2 years after I bought the place, it had been completely renovated, not only my unit, but the lobby and the hallways, and it looked a lot nicer. And that improved the value, or at least the perceived value, right, for people who were purchasing. And I was able to make some good money on it. That I used the profits from that sale of that property to purchase another place to live in, now in a part of town. So what I didn't mention earlier is that property that I bought was way, way, way uptown in an area called Washington Heights, which is a nice area, but it's very far away from Midtown Manhattan, where I worked and where I socialized. So I wanted to live actually on the Upper West Side. It was a lot more expensive, but with the profits from the sale of the first place, I was able to buy the second place, which I bought. I bought it, but what happened was in 2007, 2008, those values went way, way, way down. Right. Now, what my dad told me this when I bought the place up in Washington Heights, and I heard him, but it didn't really ring true until 2008. He said, Matt, you'll never lose money in real estate if you never have to sell. So as long as you can hold on to that property, right? And so that really hit true for me in 2008 because I had seen that. Luckily, I had bought my place a few years before that. So the value had gone up quite a bit. So when 2008 came and everybody's values went down, mine went down to right around what I had paid for it. I mean, no one really knows. I didn't have it on the market. Right. But from what I'm seeing in the market, it looked like it was going to be, if I had to sell it, I would have gotten about what I had paid for it. A lot of people were underwater, where they had mortgages that were more than what the value of their property was. And that's happening today in the commercial real estate market, right? Not so much in residential homes, but in multifamily, in industrial, and like all over the commercial real estate, especially in the office space.
Office is brutal space right now.
I realized back then, I really want to have something that I can hold on to no matter what happens. And so that's why I say cash flow is king, because as long as you have a property that you're going into and it's producing positive cash flow, the odds are, and it depends how rough the market might get, but the odds are that you're going to at least be able to hold on to your property, right? You have strong reserves, you have strong cash flow. So what I found is that if you have properties that have positive cash flow, you can hold on to that property and weather a storm. If things get a little bit rough, maybe you can't give out those distributions that you were hoping to from cash flow, but with strong cash flow and with strong cash reserves, you can sort of live through that. And that
Right.
has run true throughout my whole real estate career. I think that's very true today. And I think it's been, when I look at all the deals that I've done where there's been strong cash flow, there's been strong reserves, those are deals that have done well. There are deals that did not have that and did well because the market was good. And then there's deals that have not done that and have not done well because the market was rough. So I think that cash flow really is king.
Matt, this is actually a very, very important one. Let's go deeper into that one a little bit. I think it's very, 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 very important because I'm sure listeners, either yourself or you have friends or family members or whoever, somewhere in your ecosystem, if you ask them a question, are you holding it for cash flow or are you holding appreciation? Of course, the right answer, appreciation for everyone. But is it? I think that's a question we're asking when, yes, you want the property to appreciate. Yes, you do. And on long-term real estate will appreciate as compared to any other asset class. But the key here is long-term. And the question, the point that Matt's talking about, his dad was talking about is you have to have the capability to be able to hold it, right? If you got $1 million property, I'm making these numbers up, and you're, let's say, $1,000 negative in that property every single month. Today, it may seem $1,000 not much because your income and everything else works out, and you're like, $1,000 nothing because you believe this property, $1 million, become $10 million. And again, that's a hope. There's no guarantee. It could also become 1.5, or it could also go down. Nobody knows what's going to happen. But now you're taking the burden of $1,000 a month, right? Now, if you have a 10K surplus and a 1K gap, and you're savvy with your money and everything else, most people are not. Most people are living of saying that we're going to save $2,000, mark our $1,000 negative, cover the cash flow, because we're hoping in 10, 15, 20 years, this property is going to give 10x the money. It could happen. I'm not saying it will happen. But what happens if you lose a job? What happens if you fall sick? What happens if if two partners are making money, one of them passes away, right? There could be a lot of what ifs, and hopefully you don't have to face any of that. But if you've covered that downside protection, then you're golden. And the only way that I know with the guarantees of that, with a lot of certainty of protecting, is the property is producing cash to begin with, right? You're not, and now I could hear a lot of people, my friend talking in my head right now saying that, yeah, I'll just pay it all down and it's all cash. Well, then you have to start thinking about, is the return on your money good, right? So it's not a one variable problem. It's a multivariate problem. And you have to be able to make sure what do you want to optimize for? You want to optimize for something that Matt's dad talked about. You'll make money in real estate if you don't have, right? And that have is that you're not forced. I'll use a different word. It's not because you don't want to. No. Is because you're forced to. And right now in this market, a lot of the industrial office buildings, a lot of multifamily, and some of my friends I know who are being forced to sell their single families because they bought it with the hope that it's going to quadruple or 10x the money. And right now they can't afford it. So I think I want to make sure I replace the word have with you're being forced to sell it because you don't have the capability to sustain it because it's negative. So any thoughts on that, Matt?
I think you hit the nail on the head. You know, I lived in Boston for a little while, and I wanted to buy property in Boston because I like Boston. I mean, I really loved living there, but I couldn't find anything that was cash flowing. Everybody was buying properties and sort of hoping or speculating that the market would go up. And the Boston market is it's a great real estate market. Like, it's super strong. There's so many diverse employment bases. There's so many reasons why I liked it and wanted to own real estate there. But ultimately, it came down to the fact that, well, at the prices that they were being sold at the time that I was looking, I would be negative. I needed to take money out of my pocket. Or maybe if I was lucky, it would be break even. But then if things turned and the market softened and I needed a lower rents or something like that, I'd have to take money out of my pocket. And that was a scary thing to necessarily be in unless I had super deep pockets.
Correct.
And I didn't want to have all of that liability on me. I actually wanted something that was generating at least modest cash flow and also not just hoping for the market to appreciate. I know that overall, when we look at the U.S. market, depending on what statistics you're looking at, 3 to 6% average increase in real estate over the long term on an annual basis. However, there's no guarantee that that's going to continue, right? So I like to buy properties where we're able to force that appreciation through adding value, through doing things that are making it so that property's generating more income. I think that's really important too.
So Matt, let's talk about that. So we talked about cash flow being the key. What other criteria and how have they shifted? If you can talk a little bit more, few more criteria.
I have a certain criteria that I look for as a passive investor. And when I'm looking to do deals as a general partner, I want to make sure that the investors in my deal that it's going to meet that criteria as well. Right? I feel like that's only fair.
That's fair.
Shouldn't be worse than what I'm willing to invest in.
Hopefully better. Hopefully better. So I have seen that change though over time. In 2015, 2016, 2017, I think a lot of properties were projecting, and a lot of them were delivering on very high cash on cash returns, anything from 8 to 12% cash on cash return. And, people were doubling their money every 3 years. Now from what I'm seeing, both passively and the deals that I'm doing, we still look to have strong cash on cash returns over the lifetime of a deal. But when I'm saying strong, I'm still talking about like 7 or 8%, not double digits anymore. And often, in the earlier years, and this rang true in the past too, that the cash flow is maybe a little bit lower in the earlier years and a little higher in the later years. But we're looking to double investors' money in about 5 to 7 years now. Instead of 3 to 5, it's more like 5 to 7. So still, I think very strong returns. Yep. If you double your money in 5 years, that's 20% average annual return. And I believe the stock market's like around 7 or 8%, generally not long term. That's not even considering the tax benefits and everything else. This is just straight returns.
Correct. And so it still is a very attractive investment, I think, if people can execute on that plan. Right. I think it's a very attractive investment.
No, I completely agree, Matt. I think that makes sense. Now let's talk about one thing that I keep hearing from my investors, my friends, that why invest in deals where you're getting 7 to 8% because the risk is high when I can get 6% in treasuries, 5 point something in treasuries. What are your thoughts on that? Of course, you're losing on the upside, right? Because treasuries, while you're making 6, 7%, 5 to 7%, depending on maybe 5-ish%, you're not doubling, right? You're just comparing capital to interest rate, but you're not necessarily capital is not moving at faster velocity. So what are your thoughts? I don't know if you have been asked that question. What are your thoughts on that?
Yeah, people have asked me about that, or if it's not the treasury, then it's, stocks or things like that. I think in general, there's risk involved in any sort of investment. I think I mentioned that earlier. Treasuries sounds like, it's the treasury, it's risk-free, but it's really not risk-free. I mean, we know the, Silicon Valley Bank, like that whole debacle, they had invested in a lot of treasuries and things of that nature that are supposed to be more stable, and they were stable, but when the interest rates in the entire market environment shifted, they were sort of in a bad position. The other thing is I don't know, I tend to not be in this camp, but there is the, anti sort of US dollar camp, right? There are people who think that, hey, the US dollar is, a fiat currency. It's not really backed by anything except for the good faith of the government. And will our government be around forever in perpetuity, or will something happen? Will the dollar collapse? Will China become the new superpower, right? And I think there's a lot of visionaries out there and smart people like Ray Dalio who are pointing at signs that say, hey, it looks like maybe maybe China is becoming sort of the global superpower. And, if something like that were to happen, what does that mean to the US dollar? What does that mean to the treasury, especially with our deficit, which keeps growing and growing? You have Congress who in many recent years does not come up with a balanced budget, right? Yeah. So like U.S. bonds and things of the rating of them have gone down, right. And so there's risk is all my point. I'm not saying that any of that is happening. I'm just saying there's risk involved in anything. So if you can invest in real estate and get sort of the same returns that you might in a treasury or a stock, but there's also that opportunity upside. And when you do think about investing in something that's like a physical, tangible asset, like real estate, which is bricks and mortar versus just, ones and zeros on a screen, there's still value. Like whether the dollar is around or we're, trading chickens again or whatever, people still need a roof over their heads. And so there's always going to be some sort of intrinsic value to real estate. And so those are some of the reasons why. And I think people should invest in treasuries and people should invest in the stock market.
Yeah.
But real estate should also be part of your portfolio as well. I'm not a financial advisor. It's just what I think. I think, investing in a few different asset classes so you don't have all your eggs in one basket, so to speak, is probably a smart strategy.
Yeah, I think I was just about to say, I think there's not one or the other. No, it could be. Like for me, it's one or the other. But it doesn't have to be because I believe in the asset class, so I'm pretty bullish on that. But if somebody were to say that, hey, I want to buy treasuries as well, perfectly, go buy it, right? But do you put your entire portfolio in treasuries? That's a question I think we want to start asking, right? With the conversation that Matt and I had, that's really use that as a framework and build your own model of, I think and if you search on the internet, there's multiple models. Ray Dalio has model, seasonal model, I think he calls, I can't remember, evergreen. There's Yale has open fund model. There's people like George Gale who has a 10 model. There's so many diversification model, but the goal, I'm not saying which model is right because one model will resonate better with you. It's no one saying one asset class only have to go, right? Except unless you're Warren Buffett, which is you just go down in the businesses that you understand. And for me, it's going to be real estate. That piece I understand. So I'm pretty heavy on that. But if you're not in that camp, it's not a question of this or that. I think the question is this and that, and by how much percentage, and with who. And that's a very important question. Do you want to start like Matt started, where I started, where I want to own my own property, I want to control it. Just before I got on a call, on this recording, I got a call from a tenant for one of the properties that like the water heater broke. And literally I had to pause the conversation with Matt saying, Matt, let me take that call because it's important. And
yeah, he's not making that up. That really happened.
It had really, really happened. I'm like, okay, so do I want to be that camp or do I want to be in the camp where I give the money to Matt or Saket and say that, you know what, you run with it. You take that call of water heater being broken. I don't want to do that. Right. So I think that's a decision you have to make. And then which specific asset class works well. So talking about asset classes within real estate, Matt, I know you're still very bullish on multifamily and so am I. But multifamily over the last several months, if not a year, you've seen a lot of noise, negative noise that's come out of the media, right? Help us parse that noise for our listeners. What's true, what's myth, and where do you see the market?
Well, I don't even know what all the noise is. Like I tend to ignore it.
Good.
What I'll say is, yeah. So a lot of people are concerned about the interest rates, right? That's the biggest thing when it comes to noise. And I have a YouTube channel and I did some predictions at the beginning of the year on what I think is going to happen. And I still hold true to that. I had said at that time that I don't think there's going to be a lot of movement in the interest rates until about halfway through the year. But I think in the back half of the year, we'll see interest rates come down, maybe a full percent, right?
Yeah.
I don't think we're getting back down to 3%, right? There was mortgages at 3%. I don't know that that's happening. But, when you look at the different indicators that are out there, it looks like we'll probably come down, 1% to 2% over the next, 1 to 2 years, right? And then we'll be at sort of an equilibrium, like a long-term average for mortgage.
Which is still pretty low.
Right.
Still pretty low.
Yeah, look, it is. And, when I'm looking at multifamily today, a lot of people are concerned with the market, right? Where's in terms of like the location, right? Where is the property? What is that market doing? And I'm not going to say that that's not important at all because it's important, but I think what's more important, at least the way that I'm looking at my deals and approaching it, is how is the deal structured?
Yeah.
Right? If I can get long-term, debt at a fixed interest rate, and I know that going back to Keystone Concept number 5, that the property is going to cash flow, that's a win for me. And I'll give you a specific example of a deal we did last year. So we did the deal last year and we were able to assume the sellers. So we did a loan assumption and we were able to get, a lot of multifamily deals at the time. You were getting quoted 7 to 8% interest rate. We got this for a 3.8% interest rate. And it was agency debt, so it's fixed it was a 10-year note, but it was 3 years in. So we have 7 years, which is plenty of time for us to execute our business plan and exit. Or we could refinance. I mean, we have a lot of value that we're adding to property. So that deal made a lot of sense because of the way we were able to structure the deal. And it happens to be in good, very good locations. But I think that that's really important, is what kind of debt are you getting? How are you structuring it? What does your capital stack look like? What is the long-term plan? If people are going in and just buy something because, they think they can get a deal right now because maybe there's a distressed asset, a distressed mortgage, and they can get something, at a discount, that's great. But are they just going in there with floating rate debt and planning in 2 years, say, oh, the market's going to recover in 2 years? Because we don't really know what's going to happen. And that is a bit riskier than looking at something 7 years. It'd be even better if we had something that we could look at 15 years. I have a project that we're working on right now, which is a new construction project, and we're planning to hold it for 15 years.
Yeah, no, I love that. Again, I think, Matt, all things goes back to the wisdom that your dad has. You don't want to be forced to sell it. So you can take a 2-year loan, 3-year loan. Realistically speaking, if you have 7 to 10 year terms of a loan, you'll see a shift in the market in the positive direction. Will we see that shift in the market in the positive direction in the next 1 year or 2 years? We may. Nobody knows. But the chances of not happening is also pretty high, right? I think that's really where you, as an investor, you have to start gauging. And you do not want to listen to your sponsor or general partner on there, because their thesis is going to be, while it's very true, and they're not going to lie to you, but everyone reads data very subjectively. Everyone has a subjective, there's a lot of noise, and also depends on which data you're listening to, right? Because there's a bias.
My father-in-law, I just saw him this weekend, and they were talking about something medical. He's a doctor, but he said, I can basically create a study that'll have the results that I want, right?
Definitely.
Put things that's gonna kind of make your data points very true.
So data is I think I always say, and I was a data guy way back when, data lies in the beauty of the data lies in what really do you want data to say? Do you want me to say the stock market is going to get 15%? I'll pick a year. I'll pick a set of years where the average performance is 15. But is that the right information? Right? So I think what I always say to that is that build your own thesis. Get smarter. Even as a passive investor, you have to know these macro concepts. Understand them, so when a deal, when a ad or a socket is presenting an opportunity, you're not just taking our word for it, right? You think that, okay, interest rate's going to take more than 2 years. So if you have a floating debt, which is going to readjust in 2 or 3 years, and you're not buying a rate cap, you already know that the risk has gone considerably higher. Now, it may work in your favor, but there's no guarantees. At least in 7 to 10 years, there's a higher probability of it working in your favor. There's still no guarantee, but the probability changes. So, Matt, this is great, man. Dude, we can talk about this forever. Tell me more. Tell me one thing that you're seeing. Are you thinking the market's going to bounce back? If I give you the crystal ball, what is your crystal ball saying? Bounce back tomorrow or bounce back next year?
Oh, not tomorrow, next year, I think what's going to happen is that the Fed will lower the interest rates. And I think once we see the first lowering, right, the first quarter of a point probably is what they'll do. And maybe that'll happen towards the end of the first half of the year. It's definitely, people were saying March, and I didn't think it was going to be
not
March.
Going to happen. Yeah.
Ed's most recent statement said, not going to be March, but maybe May, maybe June, who knows? But I think it'll definitely happen before the end of the year. I think that's going to bring a lot of stability into the marketplace. Right now, there's a lot of uncertainty. It's not as bad as when the rates were going up. Now that they've paused increases, it has brought a lot of stability in. But I think as soon as we see the first drop, it's going to bring a lot of things. I think there's going to be a surge in purchases of personal homes. I think we're going to see that go up, which, may or may not be followed by commercial. But I think commercial will start to stabilize a bit. And so I think it'll take time. I don't think it's going to be a quick recovery unless, we end up in some crazy sort of recession. But, all the indicators that we're seeing right now is still that the jobs are good, the economy is still healthy. So, we'll have to see what happens.
Matt, let's know one thing.
Yeah.
You said that the home purchase is going to go up, right?
I think
so. So there's a paradox there. So let's talk about that paradox. So the home prices are seeing slight decline in most places. It hasn't crashed. It's seeing that decline. As you start and with a higher interest rate. Now, let's say talk about a year from today, the interest rates have seen some shift in the positive direction, which is lower. The prices go up, but the interest rate also goes down. Net, nothing has changed, right? You're buying a more expensive home at a cheaper interest rate versus you're buying at a current value of the price at a slightly higher interest rate. Because we're not talking about 2 to 3% drop, a percentage point drop. We're basically saying instead of 6, it may become 5, right?
Okay.
So when we look at that and trying to figure out more the way the buyer psychology works, why do we say that? Why do you say right now that the residential market may see an uptick of the number of purchases?
Oh, just because, volume of transactions is like, I don't have all the data on it, but it is very low, right?
Very low.
It's an all-time low. It's very low, right? And I think that the reason why is because interest rates are very high. And if I am an owner of a property and I bought it at a low interest rate, maybe I'm not going to be incentivized to, now I'm fortunate enough where I have a property that I live in with a 2.75% interest rate.
Don't say, yeah, you're not gonna exchange it for a 6% or 7%.
Right. Let's say this property is worth, I don't know, let's say $400,000. I'm just making this up, right?
Yeah.
If I try to move into another place that costs $400,000, my payment's going to be a lot higher because, my interest rate's going to be 6%. So I'm not inclined to move unless I have to.
Yeah.
But I think there are people who maybe want to move, but they've been kind of hesitant because going from, 3% to 6%. Then maybe if they're only going from 3% to 5% and they've been waiting that, they're ready to move. I'm ready to move.
Yeah.
Not me. I'm just saying, like, let's say I'm ready to move. I want to move, and I want to move from my $400,000 property to a $700,000 property. And I have the income and everything to do it, but I've been afraid to because of the interest rates and my payments going to be so. But at a certain point, it's going to be like, all right, I'm willing to.
I'm going to make that jump. Yeah.
Yeah. And I think we're going to see that, and I think we're going to start to see some movement because I think a lot of people have not been moving in the past couple of years because of that. And I think we will start to see that once rates start to come down. What's going to happen, I think, psychologically, because I was talking with my friend about this literally 2 days ago, and he does not know anything about real estate, really. I mean, he owns, and he's looking to sell his home, and they have it listed at what he thinks is a good price, but they haven't really had any movement yet. And he's like, yeah, I don't know, but, I think. And he was saying that his realtor had told him, I told him this, and he's like, that's exactly what my realtor was saying. I said, I think as soon as there's a little bit of movement, people are going to start to worry.
Yeah.
That the pricing is going to start to go up.
Correct.
And so I think it's going to kind of feed on that. So I think pricing will go up. I think interest rates will go down. I think ultimately your monthly payment might be about the same as it is now, but psychologically, feels a little bit better to be paying less interest.
I think it's also, if the interest rates are going low, the confidence goes up, right, off that, because that means the stock market's going better. So people feel wealthy, even if it's paper assets, doesn't mean anything. But I think the overall there's more confidence in the U.S. economy, jobs, and everything else, right? I think it's again a multivariate problem, and you have to kind of build your own thesis behind it. I love that conversation, Matt, dude. You and I can talk forever. I want to be respectful of your time and also the time here. We've got an over 40 conversation. I think there's so much people can hear from, although I'm sure they love you. So, Matt, towards the end, I want to end with one thing, right? So, as you're raising your kids and you reflect on your own life, what's one value you're trying to consciously instill that could alter the migration of their life?
Wow, that's a deep question. No one's asked me that question before. There's a few different values that we, meaning me and my wife, try to instill in our children. And I think it's about integrity and it's about being kind. And, and I like to think that I'm leaving the world a little bit of a better place than it was, when I got here. That's something that I talk about a lot in, on my social media and my book and things like that. That it's really important to me to be making improvements, value add to properties, sure. But we try to make improvements to the lives of the residents of our communities. We try to make life better for the staff that work at our communities. And then we try to enhance the lives of our investors too by making nice profits. But it's really about trying to make a profit with a little bit of purpose behind it. It's not a charity, and I'm not curing cancer or anything by any stretch of the imagination. And I try to, help out those causes and donate to them. But I do think that every one of us in our own impact in the world can make it positive. And so that's something that I try to instill in, I try to do in my everyday life, and I try to instill with my family as well.
Beautiful. Thank you, Matt. Matt, next question. As you reflect on your conversation with investors, your friends, and you see the world the way you see it, where do you feel humanity as a whole is lacking right now? Where should humanity?
I think the biggest problem with humanity at this juncture is technology. And I'm a huge fan of technology. So don't get me wrong, but I do think, everybody looking at screens all the time does not allow for, I think, really truly building rapport and relationships. That's one of the things that has helped me succeed in my life and in real estate in general also is building relationships with people. And so getting people off of screens a little bit more and interacting with people on a human level, I think is important. Also I have concerns with, and I'm active on social media. So, don't get me wrong, but like the algorithms kind of feeding you what you already think.
Definitely.
And those thoughts, and maybe you're not getting introduced to new thoughts is, it's important to understand things from all perspectives. So yeah, I'm a little concerned with how humanity is interfacing with this technology that we've created, and hoping that I'm hopeful, again, there's that word, that we'll be able to use technology and the powers that it gives us, which is wonderful, in a way that doesn't destroy humanity.
You'll love that answer, man, because I think that's so true. And I always say that there's only two roles to play on social media. You can consume or you can produce. I would rather have you produce on social media than social, because you can't change people who want to consume. But if you can produce more, which is less noisy and more objective, if we can overpower the social media with that, no matter who you're listening to, you're going to listen to your thoughts, challenging thoughts, and something that will challenge you. And that's really where the growth is. So Matt, love that conversation, man. Thank you, Matt. In our almost 50 minutes of conversation, is there one thing that you think you wish I had asked you, but I didn't ask you? Beyond where they're going to find you. We're going to talk about that.
What's my favorite Broadway musical? No, don't.
There you go, man. Let's do that.
I can't. I can't.
That's yours.
But no, I don't think so. I mean, it's been a pleasure talking with you, though, and I've enjoyed the conversation quite a bit.
Well, thank you, man. Thank you, Matt. So where can people find you? Where can they find your work? The deals you're working on? Where can they learn more about it?
Go to Picheny.com. I'll spell it real quick. Picheny.com. I'm sure you'll put a link in the show notes to it. That's where everything is. I got a ton of free content there. Free videos, free downloads about investing passively or actively. I coach people on how to do active stuff. So there's tons of resources there. So I recommend go to Picheny. You can check out my book. You can reach out to me. I love chatting with people about real estate.
Love that. I think he's not lying. Do that. You should take advantage of picking his brain, and maybe he'll tell you what his favorite is.
Reach out to me and I'll tell you on a one-on-one conversation.
Well, thank you again, Matt. Really, really a pleasure to talk to you again, man. And I'm sure our paths will here. Thank you. And listeners, if you're listening to this part, thank you for giving us most of your time. We don't take it lightly. The show is only possible because of you. So thank you again for doing that. Hopefully you draw some value out of that, of how to look at the future of the investments. When I say future, next 12 to 14, 24 months. Because that's really how far somebody's telling you they can project 5 years down the road. Chances are it's a projection, and it's coming with a lot of assumptions. And I think you can only see less than 6 months out. So hopefully this conversation sparked some interest in you. If you're not an investor, you're going to start looking at it. And if you're an investor, you're going to become a better one. Awesome. Well, thank you again. Appreciate it.
Thank you.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Socket on an investor call. That link is waiting for you in the show notes below.